Hi everybody, it's Peter Schiff. This is Saturday, July 30th, 2011. Well, over the weekend, Congress is going to be in session trying to avoid the apparent crisis that's going to occur on August 2nd, which is Tuesday, if we fail to raise the debt ceiling. Now, I agree we are headed for an economic crisis, but as I said before, it's not because we failed to raise the debt ceiling, but because we succeed. You know, every time you have a debt ceiling increase in a politically charged environment, you always get this kind of brinkmanship, you get this kind of theatrics. Maybe this is even greater than we've had it in the past, but there's no doubt in my mind that at the end of the day, Congress will do the wrong thing and increase the debt ceiling with very little real meaningful cuts to government spending. Despite all of the grandstanding on both sides of the aisle, I think this is, again, more of a charade for the voters, and the media loves it, of course, because they get to report about the crisis. But this is not the crisis. It is coming. I mean, if you want to think about the situation, it's maybe analogous to a family that decides, maybe it threatens its credit card companies, that they're going to tear up their credit cards. They're not going to live beyond their means anymore. They're not going to run up any more debt. They're simply going to spend the money that they earn. Now, is that really a crisis? Well, it's something that they choose to do. It might mean that they have to live with the consequences of that decision. They have to have a more frugal lifestyle, but the choice is theirs. They dictate the terms. Maybe they decide that they're not going to cut up all their credit cards, maybe just most of them. Maybe they'll just reduce the amount of money they charge every month. They can decide. But ultimately, it's a good thing because they are acknowledging a problem and doing something about it. The real crisis would come when the credit card company sends you a letter that says, we're not going to let you borrow anymore. Your credit line is now cut off. You've borrowed so much money, we're worried that you're not going to be able to pay it back, and so we are not going to let you borrow any more money. That is the real crisis, and that is the crisis that's coming to the United States. Right now, we're simply saying we might choose not to borrow. Well, the crisis comes when our creditors say we choose not to lend, because that ceiling, that lending ceiling, is something that we cannot raise. Now, of course, it's not that our creditors say we're not going to lend you any money. They simply say we're not going to lend you money at these low rates of interest, because obviously there is some rate of interest at which we will be able to attract lenders. But the problem is that rate of interest would be so high that it would be draconian, that it really would force the U.S. government to make across-the-board cuts in everything, including Social Security and Medicaid. See, right now, Congress can prioritize interest on the national debt. We can avoid default if we want to, and I believe that we will, only because interest represents such an insignificant, well, actually not insignificant, maybe 10% of federal revenue, but still, we can make the interest payments without sacrificing these sacred cows. However, when interest rates rise, as they inevitably will, and interest consumes better than 50% of all federal tax revenues, at that point, we have to make deep cuts in the entitlements that Congress holds so dear, and that is going to be when the real crisis happens. Not now. This is simply a charade. You know, I've seen some really ridiculous arguments about what's happening. For example, Treasury prices have been rising. In fact, the yield on the 10-year Treasury is down to 2.8%. That's the lowest it's been in some time. And people are actually saying that the reason Treasury prices are rising is because the market is fearful of a default. I mean, how can that be? If the Treasury is going to default, how can the debt that they're defaulting on be going up in value? The argument is that, well, if we default, there's going to be a big sell-off in the market, and as a result, there will be a flight to quality flow into U.S. Treasuries. Well, wait a minute. How can Treasuries be quality if they're in default? I mean, if they're in default, by definition, people aren't buying them. I mean, if people are really going to buy our bonds, even if we don't make any interest payments, then why bother making them? Why? It would save the taxpayers a lot of money. The truth of the matter is that is not why Treasury prices are rising. They're rising, I think, because the U.S. economy is slowing and because nobody believes that there's going to be a default. Instead, what the market believes is that the Fed will keep on monetizing debt, that they will keep on buying treasuries and printing money to do it. That is why the dollar is hitting record lows. That is why the dollar hit an all-time record low on Friday in terms of gold. Gold's at a record high. But also, if you look at the dollar in terms of other fiat currencies, we hit all-time record lows on Friday against the Swiss franc. In fact, we were clobbered against the Swiss franc on Friday, but we had also hit all-time record lows against the Japanese yen, against the New Zealand dollar. A number of currencies are at record highs. If you look at the price of U.S. stocks in terms of gold, the Dow is now below 7.7 ounces of gold. We took out a key support level at around 8 to 1. We're now trading at levels the Dow hasn't seen since the lows of March of 2009. And to me, this is indicative of a coming currency crisis, not a coming bond crisis, at least not yet. Now, when interest rates ultimately skyrocket, which they will, that is when we're going to have the real economic crisis, not now. And of course, if you want to look at how this crisis is building, look at the GDP numbers that the government reported on Friday. And before I get to the most recent ones, let's look at some of the revisions from prior years. The government now revised down the fourth quarter of 2007, which is when the recession started. The government had been telling us that the economy contracted at a 4.1% annualized rate in the fourth quarter of 2007. Now they're saying it was 5.1% contraction. They also revised down all of 2008. They originally said that the economy was flat in 2008, and now they're saying that it contracted by 0.3%. We've also got a revision downward in 2009. The government originally was telling us that the economy shrank by 2.6% for 2009. Now they've revised that to 3.5% contraction in 2009. Now 2010 is the one year that we had growth. The government actually upped that from 2.9% to 3%. Rather trivial increase. But more importantly, what is happening this year? Well, the government went back and revised down the first quarter of 2011 from 1.9% all the way down to 0.4%. That's almost zero. That's practically no growth at all. Also, in the second quarter of 2011, the GDP expanded by only 1.3%. That's it. And in fact, if you take those two quarters and combine them, the economy grew by less than 0.9%, I think 0.85% annualized for the first half of 2011. Now, in my opinion, the economy actually contracted. Because remember, in order to get the GDP, the government has to deflate nominal GDP by the number that they assume as the inflation rate. Now, if the government is underestimating inflation by at least 1 percentage point, and I think they're underestimating it by a lot more than 1 percentage point, then the real economy actually contracted in the first half of 2011. And in fact, the U.S. economy is right back in recession. And that makes sense. That's why we're not creating any jobs. I've said this for years now. It's not a jobless recovery. It's not a recovery. That's why there's no jobs. We are back in recession. And as the market begins to digest this, as we get the next round of employment numbers, and I expect the unemployment rate to continue to rise. In fact, I believe that the unemployment rate is going to go back above 10% and actually hit a new record high for this contraction, higher than at any point in 2009. The Fed is going to christen QE3 if it hasn't already launched the ship in secret, which in fact it might have already done, and that might be a better explanation of why Treasury prices are in fact rising. But when the world wakes up to this reality, that the U.S. economy is back in recession, that the stimulus is wearing off, and the hangover is setting in, that we're going to have to keep printing more and more money to try to prop this up, that's when it's not going to be about the debt ceiling. It's not about how much money we're willing to borrow, but about how much money the world is willing to loan. And they're going to figure this out, and they're going to stop lending. In fact, I've actually heard rumors that the Treasury is considering maybe selling some gold. If they sold their gold, that would be a way of avoiding default. And I've actually heard people say that this would be negative for the price of gold, because if the Treasury started dumping gold, gold prices would fall. I don't think that's going to happen at all. I think if we're stupid enough to sell our gold, the Chinese would buy it in a heartbeat. And then the price of gold would really soar because we wouldn't have any. The most foolish thing we could do it would be to sell our gold. And I don't think anyone in Washington is that foolish, so it's not going to happen. But at some point, as I said, the Chinese, the Japanese, the Saudis, everybody else who has been financing our extravagant spending is going to wake up. And perhaps all of the noise, right, all of the saber rattling in Congress about default, about how we might default, maybe this is going to shock them into reality. Maybe it's going to get our creditors to start thinking about the fact that we might default. And who cares what S&P says, or who cares what Moody's says? Remember, these are the rating agencies that had AAA ratings on subprime mortgages that went to zero. I think our creditors already know that our debt is not AAA. In fact, I know that it's junk. And I think more and more around the world, our creditors are waking up to this reality. And I think sometime soon, probably even before the 2012 election, we are going to have the real U.S. economic crisis. And it's going to be a currency crisis. It's going to be a sovereign credit crisis. That is going to make the current theatrics over raising the debt ceiling look like the proverbial Sunday school picnic by comparison. Anyway, on that note, everybody, enjoy the rest of your weekend, and we'll see what happens next week. Stay tuned. Oh, one more thing I forgot to mention, so you can consider this bonus material. Think about this for a minute. The first half of 2011, the GDP grew by 0.85% annualized. Now, the official estimates for 2011 by the Obama administration for how much the economy would grow for the purpose of making its budget calculations for 2011 are 4%. 4%. Now, the economy is growing by less than 1%. So they have overestimated the rate of growth in the U.S. economy by over 300% for 2011. Now, Congress is currently debating a budget with a 10-year time horizon. 10 years in which the single most important factor in determining the accuracy of these forecasts are the economic assumptions that they make, particularly the GDP. Now, if they're off by over 300% in 1 year, 2011, how can they possibly believe that they can make accurate economic forecasts over a decade? It's laughable. And of course, even if the forecasts themselves were correct, this Congress cannot bind a future Congress to actually live based on these budget calculations. This is only guesswork. And of course, they're not even talking about cuts over this 10-year time horizon. They're talking about reductions in the rate of increase. Under all of the plans by the administration or by Congress, the national debt increases dramatically over the next 10 years. And you know what? We don't have 10 years. We have a crisis coming in the next year or two, maybe 3 at the outside, but we don't have these 10-year windows. In fact, the reason that they like to talk about 10 years is to make the cuts seem big. They say we want to have cuts that are as large as the increase in the debt ceiling. Well, the $2 trillion plus increase in the debt ceiling is just over 1 year. That's it. If they're talking about $2 trillion in cuts, they're talking about $2 trillion in cuts over 10 years. That's only $200 billion in the first year. And of course, it's not $200 billion in the first year because the cuts are back-end loaded. There's practically no cuts at all in the first couple of years, which of course are the only years that count. And the underlying economic assumptions, even for the next 2 years, on growth, on interest rates, on unemployment, on inflation, are pie-in-the-sky nonsense. So even if we passed the most aggressive version under serious consideration right now, the budget deficit is still going to get worse, and the national debt is still going to explode out of control until we have a crisis. Anyway, bye again. Take care.